Hi, my name is George Dagnino. I'm the editor of the Peter Dac portfolio. What I would like to do with this presentation here is to show you the latest data on the business cycle and how all the various indicators interact between themselves and what they are telling now what's going to happen to commodity, stocks, and bond prices. This is my basic framework. I look at the business cycle, strong growth, slower growth, stronger growth again. Right now in this cycles, we are here. This is the most dangerous phase of the business cycles. Why? Because this is when interest rates decline, commodities declines, earnings declines, inflation declines, and they're all the forces that are correcting all the excesses created in phase 2 and 3. So this is where we are, and now the idea of this presentation is to show where we are in this phase and how we're going to come out, when are probably going to come out of it and go back into growth again. The business cycle is the outcome of business decisions and how business reacts to inputs from the governments and the Federal Reserves. For instance, where are we now? Right now we are in phase 4. Phase 4 is here. What happens in phase 4? Well, business recognized that earnings were coming down because of excessive inventories, as we will see. So in order to profit were coming down, and of course as profit comes down, the stock market goes down. In order to improve profitability, they have to cut inventories. In order to cut inventories, they have to reduce production, and of course you cut when you cut production, you have also to cut commodities and also reduce borrowing and reduce also hiring. So you have a slowdown and decline in production and commodities, which is what we are having. Then as production is being reduced, then you see inflation and interest rates declining due to what? To the fact that business has cutting production, has cutting raw material prices, is cutting on borrowing. So this is having the effect of slowing down the inflation rate and a peak in interest rates. And that's exactly what we are having now. When does earnings and the stock market start all over again? Here, when there is enough evidence that inventories are brought under control. When and how, I'm going to show you in the next few slides. This is an important chart that needs to be taken into account, and it's very important because it shows if the money supply goes between 3 and 6%, then the economy, which is the blue line, grows between around 3% with very little or no inflation. If the money supply grows faster than 6%, like here and here, then what happens? You have rising inflation and you have big recessions and a lot of volatility in the economy, as we had in the 70s and as we're having right now. Right now, what is important is the money supply now is contracting, and this is bad news because when the liquidity contracts, as we'll show you later in the following slides, then the economy suffers. Right now, the economy is in deep trouble. Why? The blue line is personal consumption expenditures, and the red line is income after inflation. So all what the programs that they've done during the pandemic here, what they really have created is huge volatility in the economy and making people poorer, and in fact they are not spending and their income is declining. So this is really the framework that we are facing for the next few years. So what is business going to do about the fact that people are not buying? Well, what business has done, responding to the huge stimulus that happened in 2019, 2021, is that they build up inventories, and notice how inventories are growing at double digits, around more than 10%, when historically they have been growing at 3%. So we have a huge overhang in inventories, and they keep producing. But the problem is the sales, the blue line, and now it's slowing down sharply and is below the rate of accumulation of inventories. So what business is finding out has too much inventories, they cost a lot of money, they cannot sell it, and of course their profit is hurting, as I mentioned before. So if you're a businessman, you know what kind of decisions you have to make. Of course, business, as we said, recognize they have too much inventories, growing at double digits when usually they grow around 3-4%. So what is and why business has to cut inventories? Because as shown by this chart, this is the yield curve. That is the difference between the 2-year and the 10-year yields on treasury bonds. As you can see here, started steepening. That is, the difference became bigger and bigger. And here it started flattening. You get smaller and smaller. The difference then became negative. The importance of this very crucial leading indicator is because the blue line shows the growth in profitability. And notice as inventory started growing, profitability first improved, but now that with inventories at excessive rate of accumulation, profitability is coming down because of the carrying cost of inventories. So business recognizes this, so the profitability will decline. In fact, this leading indicator shows that profitability will decline at least a year after the yield curve started steepening, because that's the lead time between the steepening of the yield curve and the improvement in profitability. So the bottom line is business has a long way to go to improve profitability and cutting inventories. Business understands what's going on and understands that they have to cut production to bring inventories down, and in the process are causing prices of commodities, interest rates, and inflation to come down. What they're doing right now is cutting production quite sharply. And if you notice, if you saw my previous videos, these are the business cycles that exactly corresponds to the business the management of inventories by business. So right now, business is cutting aggressively production. And what they do about managing inventories and cost and profitability? Very simple. They start cutting production. Notice work hours now are contracting quite a bit on a year-over-year basis. In the meantime, you see that wages, the blue line, is way down in negative territory. So what you see is income down in real terms after inflation, and work hours contracting, which is very, very similar to this periods here of a deep recession. Of course, you know, when you start cutting production and reduce business activity, the job openings follow very closely down the yield curve, which is the red line. Here was steepening, here is flattening, and here's contracting. And as you can see, the job openings rose more than a year after the yield curve started steepening, and then started now slowing down and going down into negative territory that is contracting. So even if, again, this is why the leading indicators are important, because even if the yield curve start steepening right now, job openings lead the yield curve by at least a year and a half. So job openings, according to this lead lag indicator, will start improving at least towards the end of 2023. That's why it's so important to follow the relationship between leading, lagging, and coincident indicators and how they relate to business decisions. This is the growth rate of the leading indicator published by the Conference Board. And as you can see from 2021, this gauge has been slowing down quite sharply and is now at levels that is in the past showed we are just ahead or into a recession. So the economy is growing slowly and probably will continue to grow slowly. Now, why is it called leading indicator? Because as you can see, it leads a recession. But what is important from an investor is that a slowdown in this indicator, which lasts several months, sometimes a couple of two years, reflects a slowdown in the growth rate of the economy. During these times, as I show in my service, the defensive sectors such as staples, utilities, or healthcare outperform the growth sectors. And this has been true also for the cycles. The defensive sectors have outperformed the stock market, except of course for energy, which is a special situation. If business is reducing production, it should not be a surprise to have commodities coming down. This is the yield curve, steepening, flattening, and inverting. And as you can see, commodities rising because of improving production. And then here, production started slowing down, and now what you see is commodities declining. So again, because of the lead lags between the yield curve in commodities and production, even if, again, the yield curve started steepening right now, commodities are going to go down to flat for many, many months from now. The impact of the Fed on the economy is given by the growth of the money supply. The money supply basically represents lending by banks. If the banks slow down the lending activity, it's because business doesn't need the money. So because they're in the process of scaling down production. But as production is being scaled down and purchases are reduced of raw materials, hiring of people, and borrowing less, what you see is eventually inflation comes down. So the lead lags between a leading indicator like the money supply and inflation is roughly a year and a half, from here to here or from here to here. So inflation is coming down big time with the liquidity in the system, that is the lack of deposits in the banking system, reduction of deposit or the declining deposits in the banking system. Therefore, this curve is going to come down for some time. So even if the money supply starts accelerating right now, it will take a year and a half before inflation starts picking up again. The blue line shows the yield curve, which is, as I said before, is the difference between the yields on the 2-year and the 10-year note. When the difference increases, the yield curve steepens and means liquidity in the system is ample. In fact, this curve is very similar to the growth in the money supply. Then here the difference decreases, so it means that the yield curve flattens, and then here inverts when the 2-year yields is above the 10-year yield. The red line is banks raising lending standard and is inverted, which means when the yield curve says that financial conditions are tightening, is reflected, as you can see, from banks tightening lending standards. So why is this chart is important? Because the yield curve leads the action of the banks by roughly 1 to 1.5 years. So even if the yield curve starts steepening right now, going up, the lending standards will continue for some time, and as I said, probably until towards the end of the year. So all the indicators are saying financial conditions are going to be tight until the end of the year. And this, of course, is not good news for the economy or the financial markets. Well, what about interest rates? Well, this is the liquidity or the deposits in the banking system is the same thing, amount of deposit in the growth of deposits in the banking system. And this is the yield on the 2-year Treasury note. Of course, when liquidity starts coming down, then you see production start coming down, then you see inflation coming down, then you see borrowing coming down, then you see lending standards increasing, discouraging more lending. What you see is a peak eventually of interest rates, which is roughly 1.5 to 2 years from the peak in liquidity. So this is likely to be the peak around between 4.5% and 5%, the peak in the 2-year yields. Well, what about the stock market? Well, an important leading indicator of the business cycle is the housing market and the housing market index, which is the blue line. And the reason is a leading indicator because that is the first sector of the economy that responds in a negative way to rising interest rates. And as soon as they rise interest rates, the housing market peaks, and it's quite typical that it peaks several months before a peak in the stock market, the green line. Here they peaked before the stock market, here peaked coincidentally, here peaked way ahead of the stock market, and in fact they are still coming down. So this is a clear sign not only that the economy is in trouble, because this will turn around only when interest rates will rise, will decline, which is probably well into the next few months. So we are heading for more weakness in the stock market considering this indicator. So the question is, does the Fed raises interest rates and they lead the market, or is the other way around? Well, this is an interesting chart because it shows the yield on the 2-year Treasury note, and the blue line is the federal funds rate, is the rate that the Fed sets. And as you can see, in every cycle, the 2-year yield declined before the action of the Fed, and it started rising before the red quote-unquote raised interest rates. So it looks more is the market, the way it responds to business decisions that raises or lowers interest rates. Just the Fed follows the market for whatever reasons they think is justifiable. What is the relationship between the 2-year Treasury note and the stock market? Let's call it interest rates and the stock market. Well, it's not what people say. Let me show you what I mean. People say that when interest rates decline, the market goes up. That's not true. Look at here. Look at this thing. The interest rates came down, the blue line, but the stock market bottomed a good year and a half after the decline in interest rates. Same thing here. Interest rates came down, but the market bottomed in 2020. Here the interest rates came down and the market bottomed here. So it's not that interest rates come down and the market peaks. That's absolutely misguided information. So if interest rates decline, this is just the beginning of a pretty sizable decline in stock prices. Now, what is the guide for rising interest rates and bottom? Well, only thing you can say that if interest rates rise, at some point there is a peak in stock prices. If interest rates rise, at some point there is a peak in the stock market. But that's about all you can say about the relationship between short-term interest rates and stock prices. The relationship between the yield curve and the stock market is even more baffling because it's not what is recognized by most observers or journalists, or call them the way you want. Let me give you an example. The blue line is the yield curve. This is steepening, this is flattening, here is slightly inverting, this is steepening, flattening, and it's inverting big time, like in 1980. Let's see what you can say. How do you know that there is a bottom in this, after a bear market is bottoming? Well, if the bear market bottoms, look where the yield curve is, how steep it is. If the stock market bottoms, look at how steep the yield curve is. The bond market bottom here, look how steep the yield curve is. So every time the bond market bottoms, a bear market bottoms, there has to be a pretty sharp steepening of the yield curve. So even if the yield curve starts steepening right now, it has to come around here before the stock market bottoms. Otherwise, this thing, it will keep on going down. Let's put it in a different way. If this is the stock market, the bear market has bottomed, look when the yield curve became positive. It takes a year and a half here before the bottom of a bear market. Here be positive, and it took a year roughly before you see this bottom. Here when positive, it took roughly a year before the bear market bottomed. So we have to wait at least for the curve to become flat when the two yields are equal, and then the bottom of the bear market will happen several months, to be optimistic, after the yield curve has flattened. How has the stock market behaved so far? If you saw my previous video, you know that during a slowdown, the defensive stocks are outperforming the market. In this cycle is the same thing. This is the utilities, healthcare, and staples. This is the stronger sectors. The S&P 500 is down. So in a slowing down economy, the best strategy historically has been to invest in defensive sector. This particular cycle is exceptional because of what's going on in Europe, the energy stocks, or with the climate change or whatever, the cutting supplies has created a bull market for energy stocks. But the bottom line is, in a slowing down economy, you have these three sectors outperforming the market, and this cycle is no exception. In a slowdown period of the business cycle, bonds outperform stocks. And this chart shows the ratio of the SPY, the S&P 500, divided by TLT, which is ETF investing in treasury with duration of 20 years or more. So the ratio is flat, saying here that in this time here, the SPY is outperforming TLT. But during this period, TLT has outperformed SPY. So it's better to be invested in long-term bonds than the S&P 500. During this period, the stock market has outperformed TLT. But now this curve here is saying, be careful, because if the economy slows down and the decline will last probably throughout 2023, then bonds may be starting outperforming the S&P 500. Another way of looking at bonds and business cycle is to look at the ratio between bond prices and the CRB, that is a basket of commodities. In this particular case, bond prices outperform the commodities. In this particular period, commodities have outperformed bond prices because the ratio declined. Here, bonds again outperform commodities. Here, commodities outperform bonds. But now there is something happening here where the bond market is showing signs of strength, as also reflected by this indicator. And again, the bottom line is that in a period of slower growth, as we are basically anticipating, or it looks like we are going to go through 2023 according to the leading indicators, then bonds might be an interesting asset class to look at. So let's see now what the current data are saying. The current data are saying that, looking at the leading indicators, that profitability is slowing down. Remember the chart on the yield curve. And also stock prices are declining. Now, why earnings are slowing down? Because business are built inventories, excessive inventories, and they have to correct those inventories that are still growing at double digits when they should be growing at 3 to 6%. So business is reacting to a slowdown in profitability by cutting production. So production now is coming down and slowing down, and of course with it comes employment and also the reduction in the purchases of commodities, and commodities are coming down. Now here, to reduce production, of course you need you have to borrow less. Why? Because you don't need to borrow for hiring people, buying commodities, or improve capacity or expand capacity. So what you see, this lack of demand now is beginning to cause inflation to decline and interest rates to decline. We are here. However, we saw that the level of inventories is excessive, and it will take at least a year to have the conditions, as I mentioned in previous slides, to reach a bottom in earnings and in stock market. So we are somewhere in here, and we have to be patient and wait for business to reach the level of inventories that will reestablish profitability and therefore the uptick again in the economy. But because of the leading indicators, time lags, this is probably going to happen sometimes, according to current data, sometimes towards the end of 2023. Okay, what is the bottom line of this presentation? Well, what we see that M2, the money supply and the yield curve say that there is a pretty sharp contraction in liquidity and financial condition, and they might likely lead not only to very low inflation, but we might even have deflation. There is a major inventory correction ahead. Business cannot increase inventory at a rate of more than 10%, 12%, when historically has been growing at 3%. So there has to be a major production, a cut in output, as shown also by surveys of purchasing managers. So this is coming. What does it mean? It means that business has to cut purchases of commodities, and therefore commodities will remain weak. And of course, they will also borrow less. So yields is going to come down, and they will follow commodities down with not only commodities, but also inflation. In this scenario that I'm predicting, and is slowly developing exactly as I've been predicting in all my previous videos, long-term bonds are likely to outperform stocks in 2023 because they're probably going to be actually the only asset class that will show some gains this year. I'm the editor of the Peter Dack Portfolio Strategy and Management, and you can have a complimentary subscription by going on www.peterdack.com. I also wrote Profiting in Bull or Bear Markets, How Business Cycles Impact the Financial Markets. This book was commissioned by McGraw-Hill Education, and has been available in US in English, of course, and in Asia in many languages. I also wrote 2 more books on ETFs and in general investing concepts. Well, thank you very much for reviewing this video, and please do keep in touch. Again, so long, until next time.